Hi everyone, Joe Gentili from Sarraf Gentile LLP. In this video, I want to give a couple of tips on how to fund an IUL policy and how to evaluate an illustration, what to ask for. So if you're in the process of looking at an IUL or an IUL is being pitched to you, one of the things that you're going to get is an illustration, right? The illustration is supposed to show you how the policy works. And if you're looking at the indexed options for the IUL, you're probably going to get an illustration showing a pretty rich and robust return on it. A lot of indexes for IULs right now are illustrating at around 6.5%. And if you fund the policy and you get the 6.5% return, it's showing a really nice accumulation of cash value over time. It's showing really nice income getting spit off into retirement. My advice is to disregard that illustration. So you're going to notice that you're going to have your indexed options and they're going to illustrate those at, let's say, 6.5%. And then you're going to have a fixed account option, which is the returns that they're showing if the money that you have is you're just getting the general account returns from the insurance company and you're not getting the indexed returns. And that fixed account return is typically lower. So let's say that the policy you're being shown has a fixed account return of 4% or 5%. You should ask for an illustration showing what the policy looks like if you're getting the fixed account return. And this is true even if you decide that you want to go with the indexed options. And the reason for this is because the rate of return that you're going to get off the index over a long period of time, let's say you hold this policy for life and your life has decades more to go, over time, you should expect the indexed returns to be very close to what the fixed account returns are. And the reason for that is because when you have an index, you're not putting your money in an actual index. That's not happening. There's no money going into that index. What's happening is the index is basically like, especially a hybrid index, one of these ones that don't exist in the real world, but only exist for purposes of the policy. It's really like a scorecard. And the insurance company is buying options from a bank to make sure that your return according to that index scorecard falls within a certain parameters. So usually there's a 0% floor, and that's really what's in one feature that's very important to the policyholder is that regardless of what the index does, you're guaranteed a 0% floor in your return. You're not going to have a negative return. That usually comes at the cost of having some cap on the upside. And there's a lot of different ways they cap the upside. It could be a participation rate, it could be a cap rate, or it could just be a volatility controlled index that when the index is going up a lot, it takes some money out and essentially takes some allocation out and puts it into cash. There's lots of ways they cap the upside. But over time, a rational expectation is that these options that the insurance company is buying from the bank are going to be worth what they pay for them. They're not going to have a gain or this 50% gain or something averaged out every year for buying these options from the bank. Just think about it from the perspective of the bank. If the bank were over time to be losing a tremendous amount of money selling these options, you wouldn't continue to sell them. So a realistic expectation is that the indexed options are going to return the same amount as the fixed account option or pretty close to it. So run the illustrations using the fixed account returns. If that still looks like an appealing product to you at those returns, then you should consider getting it if it meets your purposes and it's the best of the alternatives that you're looking at. I would also suggest that you fund it according to assuming that those returns, not the returns in the index, because that will save you problems later on. Because if you're funding it assuming a 6.5% return and over time you're getting 4%, you're going to have some pretty big shortfalls later on. So one way to address that is to get ahead of it by funding it appropriately using a much more conservative expectation. So that's how I would look at it if I was at the stage of considering buying a policy. If you've already bought a policy and you've assumed that you bought it off the assumption that the way these policies worked is that the indexes over time return more than the fixed account, that there's some sort of profit to be had over the long term by foregoing the fixed account return and rolling it into the options indexes. I think the illustrations in those instances are not showing you how the policy and the indexing options actually work. It's showing you something else. It's showing you a fantasy version of it. So at that point, if you've already bought that and you now realize that the way the policy was explained to you is not how it actually works, it probably makes sense to consult with a lawyer. Um, we're happy to take a look and see if there's anything that can be done to try to rectify the situation. May make sense also to talk to a different agent if you have a lot of cash value built up already. Maybe you want to evaluate different uses for the cash value. So as always, if you have any questions, I suggest you reach out. I'm happy to talk. And if this topic interests you, this intersection between law and life insurance, then I suggest you subscribe. Thanks and have a great day. Bye.